Welcome to Let's Talk About Money. Before we dive in, remember to subscribe so you don't miss our deep dives into how money, power, and history shape the world. Imagine a currency that not only allows you to buy things, but defines wars, topples governments, fuels entire economies, and decides who prospers and who collapses. A currency so powerful that even the countries that criticize it depend on it every single day. That currency is the United States dollar, but its dominance is neither natural nor inevitable. It is the result of political decisions, world wars, secret agreements, financial crises, and an international architecture built over more than a century. To understand how a simple green bill became the pillar of the global economy, we must go back to the 19th century, when the United States was not yet the superpower we know today. At that time, Europe controlled world trade, and the British pound sterling was the great international currency. The United States had an agricultural economy with a growing industrial sector, but it was far from being the financial center of the planet. Even its own monetary system was chaotic. Private banks issued bills, and their value could vary from one state to another. The first step toward dollar hegemony occurred during the American Civil War, from 1861 to 1865. To finance the conflict, the federal government issued its own paper money for the first time, the famous greenbacks. Although they were born amid crisis and inflation, they left two crucial lessons. First, that the state could control the currency. Second, that the dollar could become a strategic resource. When the war ended, the United States began a period of massive industrialization. Railroads, steel, oil, electricity, its economy grew at a pace that surpassed even the British Empire. By the early 20th century, the United States was already the world's largest economy, but the dollar still lacked international power. That shift began with World War I as Europe tore itself apart. The United States became the world's great lender. European nations borrowed millions to finance weapons, food, and supplies. And for the first time, the world began to need dollars to survive. In 1913, with the creation of the Federal Reserve, the dollar gained institutional stability. The Fed became the nation's central bank, capable of regulating the currency, controlling credit, and responding to financial crises. World War I reinforced the idea that the United States was the new economic center of the planet. But one key event was still missing to solidify this power: the collapse of Europe. The Great Depression of 1929 hit the entire world, but it was the consequences of World War II that permanently changed the global financial order. Europe was in ruins, Japan destroyed, and the great colonial powers on the brink of collapse. The United States, meanwhile, had its industry intact, its factories running at full capacity, and held 2/3 of the world's gold. It was the only country capable of rebuilding the international financial system. Thus, in 1944, in a small New Hampshire town called Bretton Woods, the modern monetary order was born. Delegates from 44 countries created a new global system in which world currencies would be tied to the dollar, and the dollar itself would be backed by gold. This automatically made the dollar the central currency of international trade. If a nation wanted to buy oil, machinery, food, or pay global debts, it needed dollars. But this power depended not only on trade, but also on the political and military control of the United States. After the war, the U.S. not only rebuilt Europe through the Marshall Plan, but became the guarantor of the new global economy. This meant the dollar was not simply a currency, it was the heart of an entire economic system. However, the history of the dollar was not free of crises. During the 1960s, military spending on the Vietnam War and global economic growth led the United States to print more dollars than it could back with gold. In 1971, President Richard Nixon made a historic decision to end the convertibility of the dollar into gold. From that day on, the dollar was no longer backed by precious metal. It became a currency backed solely by trust and by the power of the United States. This could have destroyed the global system, but the opposite happened. Washington struck a fundamental agreement with Saudi Arabia. Every country in the world would have to buy oil exclusively in dollars. The petrodollar was born, cementing the dollar as indispensable for any modern nation. The world's energy supply became tied to the US currency. If this gave you a new perspective, make sure to subscribe to Let's Talk About Money so you don't miss the next chapter. In the story of how money shapes the world, the petrodollar transformed the international economy. For any country from France to Japan or Brazil, obtaining energy meant obtaining dollars first. This created constant, global demand for the US currency. Even nations with no political ties to Washington depended on the dollar to survive. In this way, the United States achieved something unprecedented, turning its national currency into the most sought-after asset on the planet. But the dollar's dominance does not rely on oil alone. Over the decades, the U.S. economy developed three pillars that reinforced its strength. The first pillar, institutional stability. The second, the depth of its financial markets. The third, global trust. No other country has sovereign bonds as liquid as U.S. Treasury securities. For central banks, investment funds, and governments, treasuries are the ultimate safe asset. In times of crisis, the entire world rushes toward them. This feature makes the dollar a global refuge. During the Cold War, the dollar became a diplomatic weapon. The United States used its financial position to fund allies, sanction rivals, and influence international decisions. While the Soviet Union operated a closed system, the capitalist West united under one financial language, the dollar. The reconstruction of Europe, the rise of Japan, the growth of South Korea, and the integration of Latin America into world trade all occurred under this structure. In the 1980s and 1990s, globalization deepened this dependency. Major corporations, stock markets, international banks, and institutions like the IMF and World Bank operated almost exclusively in dollars. Maritime trade, international contracts, external debt, and financial derivatives all became dollar-based. Slowly, the dollar stopped being a tool. It became the architecture of the entire global economic system. Even when the United States faced internal crises such as 1970s inflation, the 2000 tech collapse, or the 2008 financial meltdown, the dollar not only survived, it emerged stronger. During the 2008 crisis, instead of collapsing, the dollar became even more demanded. Investors fled to the safety of treasury bonds, proving that even in its worst moments, the dollar remained the global refuge. Another key factor is the absence of real alternatives. The European Union created the euro to compete, but the 2010 to 2012 debt crisis exposed its weaknesses. China has tried to internationalize the yuan, but its system is not free, nor fully trusted by global investors. And although many countries speak of de-dollarization, none has presented a stable, transparent, universal option. The dollar's impact on nations is profound. When the dollar rises, emerging economies suffer. Their external debts become more expensive. Their currencies lose value, and imports increase in price. When the dollar falls, they gain temporary relief. The Federal Reserve, through its interest rate decisions, can trigger recessions, currency crises, or growth booms in countries thousands of miles away. Thus, the dollar acts as a silent governor of global finance. This power is also evident in international sanctions. The U.S. can block a country's access to the global financial system simply by limiting its access to dollars. This restricts trade, investment, international payments, and banking transactions. Most nations, even those critical of Washington, avoid challenging this system too aggressively, because depending on the dollar is, in essence, depending on the modern world itself. Transport, energy, trade, technology, credit, imports. But the dollar's dominance has a cost. Many countries feel trapped in a structure they do not control. Dollar volatility can destabilize entire economies, and global debt mostly issued in dollars keeps rising, forcing governments to adjust their policies to satisfy international creditors. This power imbalance has been debated for decades and remains one of the greatest geopolitical tensions today. Even so, the system appears stable because all major actors, banks, companies, governments, consumers continue trusting the dollar. And trust, more than gold or oil, is the true foundation of American monetary leadership. In the 21st century, the importance of the dollar has not diminished, it has grown deeper. Nearly 90% of all international transactions involve US dollars. More than 60% of global central bank reserves are denominated in dollars, and around 50% of all the debt issued worldwide, including in countries with no direct ties to the US, is also in dollars. No other currency comes close to these levels. The dollar's dominance extends into key sectors: international payments, maritime trade, commodities, financial technology, global services, investments, corporate mergers, and derivatives markets. Even new industries such as e-commerce, startups, and cryptocurrencies operate under the indirect influence of the dollar. The digital economy was born dollarized. However, this power also creates tensions. Countries like China, Russia, Iran, Brazil, and India have pushed initiatives to reduce their dependence on the dollar. They have created alternative payment systems, bilateral currency agreements, and regional trade mechanisms. But none has replaced the dollar for a simple reason: trust. To compete with the dollar, a currency needs stability, liquidity, legal transparency, and a deep financial market. For now, only the United States meets those requirements. Even so, dollar hegemony faces structural challenges. U.S. public debt exceeds $34 trillion. The fiscal deficit keeps growing. The massive money printing during the COVID-19 pandemic raised concerns among many countries. Some fear the system relies increasingly on expectations that may not be sustainable. But even these issues have not weakened global demand for dollars. In fact, during uncertain times, the world continues to seek refuge in them. During recent crises, the pandemic, global inflation, the war in Ukraine, the dollar became an international thermometer. When global inflation surged, the Federal Reserve raised interest rates. This caused the dollar to appreciate. It triggered currency crises in emerging nations, increased the cost of their external debts, and pressured their balance sheets. But it also attracted massive investment flows into the United States. Once again, domestic decisions in Washington reshaped economies thousands of miles away. For many nations, this represents a paradox. The dollar provides stability, but also dependency. It guarantees access to financing, yet creates global inequality. It enables participation in international trade, yet conditions economic sovereignty. The current financial order works like a connected network where not all nodes have the same power. In Latin America, Africa, and parts of Asia, partial or full dollarization has become a survival strategy. Countries like Ecuador, Panama, and El Salvador adopted the dollar to stop inflation and stabilize their economies. Others, like Argentina or Venezuela, experience informal dollarization. People use dollars to protect their savings from devaluation. In these nations, the dollar is not just a foreign currency, it is a psychological refuge, a symbol of trust their own governments have failed to provide. The dollar's impact on daily life is immense. It affects prices, wages, investments, savings, trade, and economic stability. When the dollar rises, the cost of imported food, fuel, medicine, loans, and debt increases. When it falls, it brings temporary relief. The US dollar acts as a silent force shaping opportunities and restrictions across entire nations. But the key question remains: will the dollar remain the world's dominant currency? Analysts agree there is no real replacement in the short term. The euro is politically fragile. The yuan is controlled by the Chinese state. Cryptocurrencies are too volatile, and attempts to create a multipolar currency system lack coordination. The global monetary system may diversify, but the dollar will remain its central pillar, not only because the United States is an economic superpower, but because the world is already built on dollar foundations: contracts, banks, markets, reserves, investments, digital infrastructure, maritime trade. Changing this structure would take decades and global consensus which does not exist today. Ultimately, the story of the dollar is the story of modern power. A currency that began as paper backed by gold, evolved into a global symbol of trust, and ended up ruling the world economy. Its strength does not come only from the United States. It comes from the system that everyone else built around it. A system where the dollar is the common language, the unit of measure, and the key to accessing the global economy. The US dollar is more than money. It is a political tool, a diplomatic weapon, a financial refuge, and above all, an invisible structure shaping the lives of billions. The world may change, new powers may rise, but until a solid alternative emerges, the dollar will continue to be the heart of the global financial system. Subscribe to Let's Talk About Money, because understanding history isn't just knowledge, it is financial power.